Have you ever worried about how much of your retirement savings will actually make it to your bank account and how much will just disappear in taxes? Most retirees are overpaying by thousands, even tens of thousands of dollars every single year. Not because they've done anything wrong, but because retirement taxes are far more complex than most people realize. I'm going to uncover the costly mistakes that lead to overpayment and reveal specific strategies that could save you thousands. If you're new to this channel, my name is Cody Gunn. I'm a CFA charter holder and the founder of Arrowstone Wealth, where we help clients retire by optimizing their investments and minimizing their taxes. And with that, let's dive right in. Retiring at 55. It sounds like the ultimate dream, leaving the workforce early, pursuing passions, maybe even traveling. But while the dream is enticing, the tax reality at 55 can bring some unexpected headaches. Think about it. At age 55, many early retirees are often transitioning directly from their peak earnings years. This means your current marginal tax rate might be relatively high. And here's the kicker. If you access your retirement funds before you're age 59 and a half, you're typically hit with both regular income taxes and a hefty 10% early withdrawal penalty. However, there's a critical piece of good news. A powerful exception many people either don't know about or they don't understand. It's called the Rule of 55. This rule allows penalty-free withdrawals from your employee-sponsored 401k or 403b plan if you either retire, you resign, or you're fired during the year or after you turn 55. This is a game changer for early retirees as it provides a penalty-free bridge to later, more flexible access points. There's a crucial distinction here, though. This rule does not apply to IRAs. For IRA withdrawals before 59 and a half, you need to explore other options like the substantially equal periodic payments, also known as 72T distributions. They're far more complex and they're super rigid. But why is this age 55 window truly crucial for strategic planning? It's because the years between 55 and roughly 60 often represent a unique opportunity. Your income might be lower than your peak working years, but also lower than it would be once Social Security and your required minimum distributions kick in. This is a golden opportunity for strategic Roth conversions. By converting portions of your traditional IRA or 401k to a Roth now, while your marginal tax rates might be relatively low, you pay tax on that money today. But in return, all of the future withdrawals from your Roth IRA, including all of the growth, will be 100% tax-free. Imagine taking $50,000 or $100,000 from your Roth in your 80s and it's entirely tax-free, while your neighbor is still paying all the taxes on their traditional IRA withdrawals. The tax reality at 55 creates some unique planning needs, a delicate balance of early access, state tax implications, and forward-looking Roth conversion opportunities. But as we move a few years down the road, the age 60 landscape introduces even more distinct opportunities and even more pitfalls. Age 60 marks a truly critical tax planning milestone, largely because it brings you within a 2-year striking distance of your Social Security eligibility. This seemingly small window from age 60 to 62 is often one of the lowest income periods that you are going to experience in your retirement. Think about it for a second. You've left your primary employment, but you likely haven't started Social Security yet, and your required minimum distributions from your traditional accounts are still many, many years away. This creates a perfect, often overlooked window where your adjusted gross income, or your AGI, may be at its absolute lowest level. So what does a low AGI mean for you? It means you have the available tax bracket space. This is the ideal environment for even more aggressive Roth conversions. You can strategically convert larger sums from your traditional IRA or 401ks into a Roth, filling up those lower 10%, 12%, or even 22% tax brackets without pushing yourself into significantly higher tax territory. Let's illustrate with a common scenario. Suppose you're 60, married, and your current income is primarily from a small pension or investment dividends, putting you in the 12% federal tax bracket. You could convert $50,000 to a Roth IRA, paying only 12% in federal taxes on that conversion. That $50,000 and all future growth is now completely tax-free for the rest of your life. If you waited until age 73 when your RMDs and Social Security might push you into the 22, even 24% tax bracket, that same conversion would cost you significantly more that year. Yet most retirees miss this golden opportunity entirely. Why? Because they rush to claim Social Security benefits at their age 62. While claiming early might provide immediate cash flow, it often has an unintended and costly side effect. It immediately starts filling up those lower income tax brackets. Once those Social Security benefits kick in, they count towards your provisional income, a concept we're going to explore in just a minute. making subsequent Roth conversions less tax efficient, if not outright completely counterproductive. Just 2 or 3 years of careful planning and strategic Roth conversions during this window from 60 to 62 can translate to over $50, $75, even $100,000 in lifetime tax savings. It's truly one of the most powerful minimizing strategies available to retirees, and it hinges on understanding this critical pre-Social Security, pre-RMD period. Navigating the tax code before age 62 is a distinct financial discipline. Generic advice often fails to account for the complexities of significant portfolios. I specialize in creating tailored tax strategies for this exact scenario. Click the link in the description to schedule a call with me where we'll review your full retirement plan and develop strategies to lower your lifetime tax bill. When you reach 65, 2 major elements kick in that dramatically alter tax planning: Medicare eligibility and the full complexity of Social Security taxation. This is where a truly intricate web of tax implications begins, and without careful consideration, you can find yourself facing significant unnecessary costs. First, let's talk about Medicare. While it's a blessing for healthcare, Medicare premiums are income-based. This means that the more income you show in your tax return, the higher your Medicare Part B and Part D premiums will be. This is known as the Income-Related Monthly Adjustment Amount. It's a mouthful. Or what we like to call IRMA. IRMA surcharges can add anywhere from a few hundred to several $1,000s to your annual Medicare costs, essentially acting as an additional tax on your income. What many people don't realize is that your IRMA determination is based on your modified adjusted gross income from 2 years prior. So a large Roth conversion or a big capital gain or an unplanned traditional IRA withdrawal today could trigger higher Medicare premiums 2 years down the line, effectively adding 1 to 4% to your marginal tax rate. It's a hidden tax trap if you're not looking at your income through a multi-year lens. Second, there's Social Security taxation. This is often the biggest surprise to retirees. Up to 85% of your Social Security benefits can be taxed at the federal level, and in some states, they're actually taxed too. The amount taxed hinges on a formula called provisional income. This is calculated as your adjusted gross income plus any tax-exempt interest like from municipal bonds, plus 50% of your Social Security benefits. If your provisional income is between $25,000 and $34,000 if you're single, or $32,000 and $44,000 if you're married filing jointly on your tax return, up to 50% of your Social Security benefits are taxable. If it's above that, up to 85% could be taxable. Without careful coordination of your income sources, retirees can face effective federal tax rates ranging from 0 all the way up to 22% or more before considering even potential state income taxes. You might think you're in a low tax bracket, but then your Social Security benefits become taxed or you get hit with an IRMA surcharge, and suddenly your effective tax rate jumps significantly. This is where most people get tripped up. Here's the powerful silver lining. Careful coordination of your Social Security claiming strategy, your required minimum distributions, which typically begin at 73, and your various income sources can dramatically slash your lifetime income tax bill. And here's a fact that often gets overlooked in retirement planning. Where you retire matters a lot. States like Alaska, Florida, Nevada, South Dakota, Texas, Washington, and even Wyoming charge 0 state income taxes. That means every dollar you earn in retirement from pensions, 401ks, IRAs, or even capital gains are only subject to federal tax. Compare that to states like California, which can levy upwards of 13.3% on high incomes, or New York, which has rates up to 10.9%. Moving from a high tax state to a low tax state at retirement can instantly save you between $5,000 and $25,000 a year. But it's not just about income tax. Different states have drastically different approaches to how they tax retirees. Property taxes. Some states have very low property taxes, like Alabama, while others are notoriously high, like New Jersey. This can significantly impact your housing costs if you move to one of these states. Sales taxes. While not typically a huge factor for income, high sales taxes can add up to everyday purchases and meaningfully impact your monthly budget. Estate taxes. Some states also have an estate tax or an inheritance tax, which can impact how much you want to leave to your loved ones. Geographic tax planning isn't just about finding a cheaper place to live. It's a powerful, legitimate tax strategy. It can genuinely reshape your financial future, transforming a potentially large tax liability into significant annual savings. Beyond age-specific strategies and geographic considerations, one of the most powerful and enduring ways to minimize your lifetime tax burden is through strategic account type coordination. This involves intelligently balancing and drawing from different tax buckets in your retirement. Taxable accounts. These are your brokerage accounts, savings accounts, and other investments where you pay taxes on dividends, interest, or capital gains each year. Think of these as your current tax bucket. Tax-deferred accounts. These are your traditional 401ks, IRAs, and 403bs. You get a deduction when you contribute, and your money grows tax-deferred, but every dollar you withdraw in retirement is taxed as ordinary income. These are your future tax buckets. Tax-free accounts. This is primarily your Roth IRA or your Roth 401k, and even importantly, an HSA if you're using them for qualified medical expenses. You contribute after-tax money, it grows completely tax-free, and all the qualified withdrawals are 100% tax-free. This is your never taxed bucket. The entire goal of account type coordination is tax efficiency. Instead of simply withdrawing from whichever account is easiest, you pull money from different buckets in a specific order to minimize your annual income tax and maximize all your tax-free growth. For example, in a year where you want to keep your income low, perhaps to avoid IRMA or Social Security taxation, you might draw primarily from your brokerage accounts. In another year, if you have a medical expense, you might draw from your HSA. If you have minimal income, you might strategically take a larger distribution from a traditional IRA or convert a larger portion of that to a Roth, knowing that you're in a lower tax bracket. This approach allows you to control your effective tax rate each year, which adds significantly to a 20 or 30-year retirement. And critically, this strategy works regardless of your age or where you live. Now that you understand these powerful retirement tax strategies from age-specific opportunities to location impact and account type coordination, let's discuss how to put them in action to your specific situation. So how do you take all this information and translate it into a tangible, actionable plan that saves you money? Here are the key steps for implementing your optimized tax strategy. Create a multi-year tax projection. This is the foundational step. Don't just look at this year's taxes. Work with a qualified financial advisor or tax professional to project your income withdrawals, Social Security, and RMDs for the next 5, 10, even 15 years. This will help you identify your lowest lifetime tax brackets. Those are the critical windows where Roth conversions are the most efficient. Develop a strategic Roth conversion plan. Based on your tax projections, determine how much to convert from your traditional IRA or 401k to a Roth each year. The goal is to fill up those lowest available tax brackets without pushing yourself into a higher one, while setting yourself up for future tax-free income and reduced RMDs. Evaluate relocation or tax efficiency. If you're considering a move in retirement, factor in tax implications. Look beyond just income taxes to consider property, sales, or even estate taxes in that potential new location. This isn't just a lifestyle choice, it's a major financial decision. Coordinate your retirement account distributions with Social Security claiming. This is really crucial, especially when you approach age 65. Decide when to claim Social Security benefits based not just on maximizing the monthly payment, but also how it impacts your provisional income, your tax bracket, and your Medicare IRMA surcharges. Then integrate this with a smart withdrawal sequence from your taxable, tax-deferred, and tax-free accounts. Remember, tax laws evolve, your personal circumstances will change, and the economy will shift. Therefore, it is essential for you to regularly reassess and adjust your strategy. This is not a set it and forget it, but staying proactive and informed, you can ensure your retirement remains tax-friendly and also gives you a greater peace of mind that more of your money will be available for you to enjoy your golden years. You now understand the dramatic differences in retirement taxation at 55, 60, even 65. You know how critical location can be and why coordinating your different account types is so critical. These aren't just abstract concepts, they are the tools you need to implement strategies that could save you tens of thousands, even hundreds of thousands of dollars in taxes over your retirement. If you're serious about lowering your retirement tax bill and making the most of every dollar that you saved, click the link in the description below. You'll answer a few confidential questions, and then you'll get direct access to my calendar to book a complimentary strategy call. We'll review your plan together and identify the specific opportunities to reduce your taxes and optimize all of your retirement income sources. Thank you for watching, and I look forward to helping you pay less in taxes and, even more importantly, enjoy your retirement. I'll see you in the next one.